All right. Hey, good evening, everybody. Thank you for taking time out of your busy schedule on a Sunday evening. I promise you this is going to be well worth the time. And I really do apologize for not, doing our normal coaching call this past Thursday. Like I said, I had an emergency come up. Everything is fine, but I welcome you to our advanced coaching webinar clinic. I've got a special guest with me. It looks like he's just hopping on right now. Jeff, are you with us tonight?
I am here.
Good, good. If everybody could just type in and say, yes, I can hear you, or please turn up your volume, that would greatly help us to maximize that you could hear us fine and that everything is going good. But I also wanted to let everybody know that at the end of this webinar clinic that we're having, that we are going to be having the lines open, and we're going to be doing some live Q&A with Jeff and myself. So if you have any questions throughout this webinar, you can either raise your hand, which means that I will unmute you, and you could actually talk to Jeff and I live, or you could just simply type in your question and we'll go ahead and answer your question at the end. This is just going to be a pure content call. Jeff and I are going to be going over a lot of great content, mainly Jeff because he's the expert. But besides that, I just really am excited to have Jeff on here this evening. We're going to be going over some cash flow strategies. I met Jeff a few months back, and Jeff is somebody that I instantly felt a really good connection with, that he's a good person. He's somebody that I can trust. And he's just an overall great person, looking out for others, and he's got such a great thing going on here in Indianapolis that I just felt compelled. I've actually been wanting to get him on now for a couple of months, but him and I have both been busy with certain projects that we're working on, and I'm actually glad Jeff found the time to hop on and attend this with us. I think you all will be extremely pleased with everything that we're going to be going over this evening. Like I said in a past couple of emails, I think a lot of the things that a lot of investors right now are not really focusing on is cash flow. With our current state of the economy, you can get such great deals on these properties that it would just be foolish to pass up on the cash flow opportunities right now. It's the best time to buy cash flowing properties when everybody else is trying to just flip them. Now, I'm not trying to say flipping is bad, because that's what we do 85% of the time within our business. But the other 15% we're trying to reinvest to where we're always having a positive cash flow coming in every single month. And this is something Jeff has been doing since the 70s. So I'll let Jeff kind of explain a little bit more about himself, and I'll just kind of sit back on the sidelines, and I'll actually be interacting with Jeff, asking questions as we progress through here. We're not going to take up a bunch of your time. We should be in the range of about 60 to 70 minutes, and that's going to really depend on how many questions we have from you guys. Now, we'll stay on as long as we can and answer as many questions as possible. I really don't have a whole lot going on this evening besides signing a couple purchase contracts, and depending on Jeff's schedule, we'll see how long we could go, but we really kind of want to just let this kind of go is in depth as possible, with as much content to where you could be driven after this, to where you could start understanding that you need to really invest in cash flow opportunities right now. So without further ado, I introduce you to our special guest, Jeff Ader with Dorfman Properties. Jeff, I'll let you take it away, buddy.
Thanks a lot, Jason. I appreciate it very much. Just wanted to say from the get-go here that to tell you where I started from, I I'm the founder and CEO of a company, a relatively new company called InvestIndy.com. That's InvestIndy.com. And I've been investing in real estate, buying and holding real estate for over 35 years, really 36, 37 years. I bought my first property when I was 28 years old, probably 26 years old, and now I'm just approaching 60. Another company that we have that's been in business 35 years is a property management company, and I'll tell you a little bit about that in a second. But I personally own 170 units, of which 40 of them are single-family homes and duplexes in Indianapolis, Indiana, where I've been a lifetime resident. I also own Dorfman Property Management, which is a local property management company here in Indianapolis, which, again, is celebrating our 35th anniversary along with my wife, who started the company 36 years ago. And we currently manage over 1,000 single-family homes and duplexes, or doubles as they call them in Indianapolis, for passive real estate investors from all over the country and some internationally. So we don't manage them just for Indianapolis people. We manage them for investors that are all over the United States. So another thing I wanted to tell you that I've introduced that kind of puts a good twist on this cash flow rental property business is I came up with a concept, and it's not like entirely new. It's just that I put two old concepts together and came up with kind of a hybrid new concept. And what it is it's called owner financing for turnkey real estate. And turnkey real estate is when I find a great deal and I rehab that property, get it looking very good and performing very good, and I put a tenant in that property. The tenant starts paying rent, the property starts to move forward, and the property is now positively cash flowing, and I still own it because I bought that property. I didn't get it from an assignment. I didn't do anything fancy. I just plain and simple bought the thing, paid cash with my own money, and got it rolling as if it was for myself, because I wouldn't buy it. I wouldn't buy the house if it wasn't good for me. Okay, so I'm buying it for myself, and then I turn around and I can sell it to an investor. And so now he's cash flowing, but he has to do absolutely nothing because I take over management of the property. And he's sitting back, receiving checks every month to the tune of double-digit returns on his money. And so the concept I came up with is most people, a house is 40, 50, 60, 70, 80,000 plus. Those are rental properties. Those are prices of really economical prices, low prices for rental properties. But what I came up with is a concept where I can owner finance that property. And that's the very last bullet point, as you'll see there, is I've introduced an opportunity for IRA investors, people who have 401ks, IRAs, and you don't even have to have an IRA or a 401k, and they need to be self-directed, when I'm speaking about this, but we'll talk about that later. And what happens is you can come up with 30% down with this new hybrid program, just 30% down. So if it's a $50,000 house, a person can own it for as little as $15,000, and I'm financing it for them. They don't go to a bank. They don't have to deal with financial institutions. I'm actually loaning them the money, and when they do this, the property cash flows beautifully. So it's kind of a unique little thing, and you can buy the properties in your IRA, and you can buy them outside of your IRA, but we'll talk a little more about that later.
Hey, Jeff. So are you creating a note then, just so people are kind of clear on that? Are you creating a note then for the 70% that you're financing?
Exactly.
Okay.
In other words, we got a 30% down payment, and I create a note and a mortgage put together with a quality real estate attorney, and that's exactly what I'm creating is a note for the 70% part that is financed.
Perfect.
All right, I'm ready to go on to that next slide.
Okay.
Okay, so I've been doing investing over the years. buying properties, selling properties, and accumulating a lot of properties. So I've gotten the hang of this buy and hold cash flow things because I was doing it before it was ever on TV. I was doing real estate before there was any promotional people talking about real estate and accumulating real estate, using the cash flows to buy more real estate and actually becoming financially independent through real estate by just doing some few simple things over a long period of time, and it can just do wonders for you. It can create an excellent net worth for any of you who are listening tonight. And there's nothing complicated about it at all. It's just a few basic steps. So the question is, why would I recommend myself invest in Indianapolis? And why would I recommend anyone invest in my city, even if it wasn't me? I'm kind of lucky because last year, I think it was in May of 2011, I was made aware of this. I've been buying, and I would continue to buy whether I saw these reports or not, but a company called Inman News, who's an authority for real estate agents, brokers, and investors, they ranked 10 different markets in the United States for real estate investors as to the quality of the returns they would get on their money using formulas that took into account appreciation and cash flow, both. And they looked at all different demographic factors, returns on investment, ROI, everything. And they ranked Indianapolis number one as to, the 10 best markets they picked out, and we ranked number one. So I thought that was quite, an accolade for the city that I live in, and it just made me, want to tell more people about it, that they should be putting some of their money here in cash flow properties in Indianapolis. Another big one, CNN Money, has said the same thing in 2011. And as you can see there, if you look real close, you can see Tucson, Salt Lake, Richmond, Tallahassee, and Indianapolis is at the top, and it shows a 301%. That's a return over a 10-year period. It showed at the end of 10 years, CNN Money, that, again, Indianapolis was ranked at the top of the heap. And even if they were number 9 or 10 or 5, it wouldn't matter because any of those cities are great cities for cash flow real estate. So just thought I'd bring that out to you guys, that I live in a wonderful city and home of the Super Bowl, sports capital of the world, a lot of stuff going on economically, positively here. Our unemployment rate in Indianapolis, in Indiana basically, is less than the national average, which tells you that means more people are working here. So we've got a strong economy. I saw in our newspaper it was about a month ago, an article came out in our newspaper that ranked us in a different category, number one, and that was in the most affordable city in the United States for residential real estate. That means the prices of our homes for someone looking to buy a home and live in it are relative to the income people here are earning, we were number one in the United States for that. So that means more people are going to be looking to come to Indianapolis to buy a home because it's so affordable. More industries would want to locate at a place like that where their work people could have an economical place to live. And so that factor is like icing on the cake. It's not exactly about real estate investment, but it's a corollary to it, because if you have those kinds of factors going on, the stability of your market is even more solid. So you're less likely to have the ups and downs in some of the other markets around the United States. It's very stable, yet it acts conducive to appreciation, as more people would want to move into a city like that.
And
okay, Jason,
Jeff,
that's all I have to say. Yes.
The other thing I just wanted to bring up before we go on to the next slide here and start talking about some of your cash flow techniques is a lot of people, especially from like like California and Hawaii, believe it or not, are buying a lot here. And the main reason why is, if you think about it, to get like a 3-bedroom, 1-bath in California, it's going to cost quite a bit. When here in Indy, Jeff's going to go over some case studies here in just a second, but you could literally pick these types of properties up, a 3-bedroom, 1-bath, for probably $40,000 to $60,000, and it's going to be a lot less risk than probably paying $350,000 to $400,000 for a house like that in California. You'll probably pay a lot more in Hawaii, depending on the location. But guys, the whole reason why I'm bringing Jeff on here is, I'm going to talk about, we're going to talk about Indianapolis, just because Jeff's an expert in not just Indianapolis, but just in cash flowing in general. And the main reason why I wanted Jeff to go over why is he investing right now in Indy is because we want to show you guys some bulletproof information with how we're ranking right now. And a lot of people, really smart investors, are diving in here right now. And I'm not saying everybody that's on here that didn't know about Indy, I'm not saying you're not smart. You might just be doing flipping like I've been doing for a while. And I didn't even know Indianapolis had these type of rankings until I really met Jeff. So the investors that are really finding out about this are people that do have self-directed IRAs, which we call SIDRAs. Some people call them SIDRAs. But some of these custodian places that are actually holding these self-directed IRAs are saying, where are some really great areas to get a really good return on your cash. So with that being said, I'm going to have Jeff kind of talk about some of these case studies here, these buy and holds with the kind of cash on cash return Jeff is seeing on pretty much the majority of the deals he's taken out. So Jeff, I'll let you talk about this one here on 4012 Boulevard.
Very good, Jason. Thank you. Jason's absolutely right. People are flocking to Indianapolis from all over the world. I got people. There are people coming from Australia, New Zealand, even some from England, a lot from California. I manage properties for over 200 different individuals who are from California. I've got clients from New York. So, they're coming from all over, and people who just live here in Indianapolis. But there's plenty of good deals out there. So this is one of them. The 4012 Boulevard place just recently sold this house to an investor within the last 30 days. The first 3 properties you're going to see, I have literally sold to different people in the last 30 days. So this is not something that happened 9 months ago. This is right now. And this is what's going on right now because each of these properties are managed long-term for these investors by my property management company. It's a seamless organization. They can buy the property, get the checks, get the cash flow, and then have the same company manage it so they don't have to go here, there, and everywhere. And it's all done by me and my companies. So the first one is a house that sold for $41,000. And if you look in the left-hand corner, you can see $41,000. And with this innovative plan, this owner financing plan I have, where I'm actually financing it, no, you're not going to the bank. The buyer only had to come up with $12,300. So if we take 41 less 12,300, we've got a balance of a loan of $28,700, which I'm financing at 8% interest with a 30-year term, 30-year amortization schedule, and a 10-year balloon. This is a 3-bedroom, 1-bath. It's over 1,000 square feet, 1,144. And so if we move to the right-hand side of the page, we can see a little bit more detail on what the cash flows are on this property. And something I want to make a note about here, back to the Sidra and what Jason was talking about, this is very, very, very important, this IRA business, because a lot of people have money in their 401ks, as I mentioned before, and their IRAs, and they're not doing too well, quite frankly. A few are, but the majority of people out there are not. And so if a person does what they call the self-directed IRA and gets away from the banks and the stock brokerage companies and decides I'm going to direct my own investments, which we can tell you how to do later on if someone's interested in that. You have a self-directed IRA. You have control over your investments. You can buy gold, and I'm sure most of you guys are pretty sophisticated. You've heard of all this before. You can buy gold. You can buy stocks, bonds, mutual funds, and many, many different things that qualify by the IRS. And one of them is real estate. apartments, and houses. Okay, and so the deal is if you went to a bank, your neighborhood bank in Boise, Iowa, or in New York, or San Francisco, California, or Las Vegas, Nevada, and said, I want to put this piece of real estate in my IRA and I want you to finance it for me, even if you have the best credit in the world, they won't do it. They will not do it because it has to be a special kind of loan. And that kind of loan is called a non-recourse loan. And so what I'm doing is I'm offering that non-recourse financing, which is just because I can do it. I'm doing it. And therefore, you can buy this real estate in your IRA or outside of your IRA for just $12,300, and you own it, and you've got a note and mortgage on it, and it works beautifully. So here's the numbers. Okay, your total investment would be $12,300, no closing costs, as you would have with a bank. And in this particular example, the rent is only $625 a month. $625 times 12 equals a $7,500 annual rental income. Okay, so if we take the $7,500 you see under total investment, look at the column annual gross income, $7,500, you'll see the first thing, which is the loan, and the principal and interest payments are $2,527. And then you have expenses. You know, something I want you guys all to look out for yourselves, and when someone presents you with an illustration, a realtor, I don't care who it is, an investor tries to sell you something, you're buying an REO, and you're looking at what your projected cash flow is. Many people, they don't include these expenses. I find it appalling that someone tries to show an illustration of a rental property, and they're not putting vacancy in there, they're not putting maintenance, they're leaving stuff out that's critical, that happens. And you can't leave out stuff that's real. I don't do that. So if you'll see, you got the annual principal and interest of $2,527, annual taxes of $896. It's important to be accurate about that. I look these things up. I don't make them up and pull them out of thin air. That's a real number. That's what I had to pay, $896 on this property. That's what someone who owns it will have to pay.
And Jeff, the other thing too, I don't mean to cut you off here, but the other thing is we've been talking to, well, Jeff and I had a call not too long ago, and I've actually been talking to some other investors that are doing some cash flow across the country. Our taxes are extremely low. If you look at other places, like on a $41,000 property or $41,000 price, let's just say it's that tax assessed value, it's going to be another probably $400, $600, or possibly even $1,000 more, depending on the market or that specific state or the city. So guys, our taxes are so low here. It's such a huge opportunity, and that's one of the things I wanted to bring up too. And the other thing too, when Jeff starts talking about vacancy, Jeff, real quick, what is the vacancy rate for Dorfman Properties right now? Guys, this is pretty amazing. Tell everybody what your occupancy rate typically on the houses that you manage is typically around.
Well, I will tell you right now, I think we're fortunate. We're a good property management company, and I will be transparent in saying this isn't always the case at all times of the year or every year. But right now, the rental market, as Jason and I were discussing, in Indianapolis and all across the United States, is extremely strong because, as we know, it's a little bit tough for a lot of people to qualify for loans to buy a house. So you got a real strong rental market. And the vacancy rate for our particular company, we're 97% occupied. That's 3% vacant. That's fantastic, in my opinion, and I don't mean to toot my own horn, but that's pretty good. That's really
amazing.
Good. 97% occupied out of 1,000 houses. I had my head of operations, my leasing agent manager, she looked over at me, she says, Jeff, you need to get us more houses. I said, what do you mean, more houses? She says, I don't have any houses for rent. They're all rented. I said to myself, that's a real good position to be in the property management company because it's excellent. Now, during the winter, it's going to be a little rougher because people don't like to move as much during the winter. And there will be some fluctuation between 95 and 99%. But I'm very pleased to say that, we've only got 3% vacancy right now, and that's a good thing. And Jason's right about taxes. I'll say it, won't belabor it, but here's something else that's really powerful about investing in Indianapolis and the state of Indiana. Not only are taxes good, but we just enacted over a year ago in our state constitution a property tax cap. In other words, if we start spending money like crazy, well, that's going to be a problem because they're not going to be able to get it out of people who own property. Because the governor of Indiana said enough is enough. We're putting a cap on these property taxes, and you can't just keep taxing. And that's wonderful news for real estate investors because you know what your property tax is going to be. In other states, the municipalities are having terrible problems. And I don't want to mention specific states because somebody may live there, but most of them are not doing so financially well. Indiana right now, we have a surplus in our budget, not a deficit. I guarantee you can't count for me and tell me on more than 3 fingers of your hand of 3 states, 3 or 4 states in the United States that have a positive surplus in their state coffers. Most of them are hurting and so in debt they can't see anything but red. And Indiana is not in that situation. It's because we put restraints and budgets and caps on the spending, and one of them is property tax. So your property tax in other states could go up to 3-4%. And the government will say, fine, let's just keep taking from them. Here in Indiana, they can't do that. So that's a protection for people who are buying that cash flow real estate. All right, so to go on, we've got the annual taxes, which Jason said, and I agree, it's a good number. Then we've got an insurance estimate. Here, in this case, we're estimating at $600. And I think if we shopped it real hard, we may be able to get it under $600, but we want to have good coverage. You don't want to just try to get the cheapest insurance because you want to make sure that if something does happen, a fire down the road or anything like that, which anything could happen, you've got great coverage so that you can replace the cost of that asset and go out and buy another house if something happens. So that's the kind of coverage I recommend. Not the cheapest, but quality coverage that is at a good price. We have a property management fee, okay? That's $750. That's the cost for doing everything for you, for finding the tenants, for screening the tenants, for rehabbing the house, for controlling the contractors, for sending monthly statements, financial statements out, for sending the checks out, for taking a call at 2 in the morning, so while you're sleeping soundly, we're handling that. We're handling everything. And that's why this turnkey thing is really, really good. It means you don't have to worry. It's all on us. That's what the property management fee is. Then you've got the vacancy and maintenance. This is where a lot of companies slip that show these properties. They don't put those numbers in there, or they minimize them where they're not accurate. I put numbers in there. I put healthy numbers in there because over a 5-10 year period, you're going to experience some vacancies. You're going to experience maintenance. It's going to happen. So you can't leave it out because that's just not an accurate way to do things. So we've got a vacancy. I look at about 1 month per year. There's $600 in there for vacancy and a maintenance, $525. Now I will tell you, sometime that vacancy number could be 0 because some tenants stay for 2 years, 3 years. We found through our statistics and our databases that half the time tenants stay more than 1 year. We have them sign at least a 1 year contract, if not 2. But 50% of the time, half of them are staying more than 1 year. So that means that you would have no vacancy that first year. And that means that your return on your cash flow is even going to be bigger than what I'm showing. So what we show is an annual net income here with all those expenses of $1,602. And if we take $1,602 and you take it on your calculator, divide that by the $12,300 you've got invested, that's a 13.3% return on your money. So again, that's 1602 divided by 12,300 is 13. It's over 13%, as opposed to if you took that $12,300 and put it into a CD at the bank, our fantastic banking situation here, you're going to make $184.50 as opposed to $1,600. So your CD is going to give you $185. Your property that you control, own, and develop equity in is paying you $1,600. It's quite a contrast. Plus, you have the benefit of appreciation over a period of time because the market everywhere is depressed. It can go nowhere but up. All right, let's go to the next case study, Jason. Okay, this is another house, and I won't go into as much detail on this because it's pretty much the same scenario, guys. The same types of figures, just different pricing. This one is a house that is not too far from the other house, but it's a bargain. It was sold within the last 30 days, $37,000, and the person only had to come up with $11,100 to have this house, and they're getting over a 13% return on their $11,100. You see the same type of financing, 8%. And I will say something, because a lot of you are probably thinking, 8%, wow, that's high, that's ridiculous. Well, it isn't ridiculous, because if you can find another financial institution who's going to let you buy a property for $11,100 and going to finance you, then 8% might be a little high. But when you can't get any kind of financing period at all on something like that, and you can cash flow to the tune of between 10 and 14% and 15% on these properties, then 8% is a solid deal. It's a great deal. And interest rates will go up in the future. You're locked in here for 10 years. It's really a 30-year amortization schedule, but in 10 years, by the end of 10 years, the balance has to be paid off on this thing. So let's go on to slide case study number 3, Jason. Okay, and now here we've got a duplex, or a double as they call it in Indianapolis. This is a house with it houses like 2 sets of tenants. You've got one on the left and one on the right, and each side of this house is a 3-bedroom, 1-bath. This sold about 3 weeks ago, and it sold for $59,900, and the down payment on it was $17,970. So the amount financed was $41,930. So a person was able to get this for $18,000 approximately. This house that brings in a 15% after expenses. It brings in a 15% annual ROI on their money. Now, here's something real interesting about this stuff here, because I have a program in addition to all these cash flow properties. And by the way, if someone buys this outside of their IRA, which is a wonderful way to do it, that's how most people do it. A few buy them in their IRA. You don't have to worry about this, that, and the other, but you can go to a bank and just get a regular loan. If you can get 6% or 5% more power to you, then you should do it. And if you do it outside your IRA, it doesn't have to be that special kind of loan that I've talked about, that non-recourse loan. And so you can go to a bank, and if you got good credit, you can get 5% interest, 6% interest if you have good credit. And this illustration would be even better. But the deal is, let's say you did it the way I suggested here, and I provide the financing because your bank said no, or maybe you didn't have perfect credit, and I don't need you to have perfect credit. I don't need my buyers, because the house stands for itself. The house, I'm financing the house, not the buyer, so to speak. So the deal is, we're running 15%, and every year, if you look down at the bottom, you see that annual net income on the right-hand side of the page, right above the cash on cash return in yellow, that annual net income. It shows $2,708. Well, if you take that money and you apply it towards the loan balance of $42,000, that balance starts dropping rapidly, and the interest that you're paying starts dropping. So what I'm saying is, take the cash flow. I call it the accelerated retirement program. It accelerates your retirement. You take the $2,000 or whatever profit you get. Some years it may be $1,500. Other years it may be $3,500, because these expenses I'm showing are not guaranteed. They are projections, and they're not guarantees. They're only estimates. Let's call them estimates. But it's typical. Some years they will be higher. Some years they'll be lower. But let's say it's $2,700 is in my projections. You take that and you apply it towards the balance of that loan, that $42,000. And in 10 years, anywhere between 8 and, let's say, 9 years and 12 years, that property will be free and clear, and you will have that loan no more, and you will save a ton of interest. But instead of taking the money out and spending it and blowing it like a lot of people do, you apply it towards the balance of your loan. That thing is free and clear in 10 years or less. Now, let me tell you something about free and clear property, because I own quite a few of them, and it took a while to get there. Free and clear properties with no debt on them, no mortgages, they're the best deal in the world. They're the best properties you can own, unencumbered properties, because then your cash flow on this property, after you've paid off your loan payment, I'm just going to do a little calculation on my calculator real quick, and your cash flow, your cash flow is going up significantly. Let me just do a little figure in here and see where she's at. Okay, hold on. 2708. And then I get rid of the 3692 loan payment. Okay. And you're over it looks like you're over $6,000 in cash flow a year. $6,000 coming in because you paid off your loan. Now here's the beauty of that, guys. I'm going to give you the exact figure here because my calculator was acting up. I was hitting the wrong buttons. The exact number is $6,400 a year in cash flow from this little house that you started off with only $17,970. If you own 10 of those, let's say you own 10 of those houses, and in 10 years you're saying, wow, I kind of like to back off on my work. I don't really want to kill myself anymore or whatever. In 10 years, that's $64,000 coming in a year, and you're doing nothing. You do absolutely nothing to earn it. $64,000 from just 10 houses coming in year after year. And as rents rise, that number can possibly go up. And the value of that asset that's showing $59,900, no, I can't say what appreciation is going to be, but even if it was just 2% a year, you're probably talking about an $80,000 asset now instead of a $59,000 asset at the end. So you see, not only have you got $60,000 coming in here from 10 houses, your asset has increased. So as you wish, you could sell off a house or two, and there's no debt on it. So you're talking about selling off $60,000 and just putting it in your bank account. So there's all kinds of great things you can do with this real estate. All right, let's go on to the next one. Okay, these are properties that I have available right now that I just put back out onto the market. The other ones, they're sold. Here's one on Goodlet, and it's just a great house, and it's running $45,000 with a $13,500 outlay out of your pocket, and again you're getting a 13+% return. Same thing, same scenario, and it'll do the same as any of the others I showed. We can go on to number 5. I don't want to belabor this too much. I just want to show them some different choices and different alternatives. This is a different property. It's a 4-bedroom, 2-bath house, 1,900 square feet, 1,900 plus, and this is a $50,000 house that a person can get for $15,600. Again, on that money that's there, it's a projected 13.37% return on the cash. I'll go to the final one. This one's available also. It's not been sold yet. Just been kind of put up on the market. It's not even on my website yet. These last 3 are not. I haven't even had a chance to put them out on my website. Number 6. This is a duplex. I showed you one earlier. This is a little different duplex. This is a 1-bedroom aside duplex. And it is a $55,000 investment. But with the financing component, a person could put 30% down and get it for $16,500 out of pocket. And it's showing a 17% return. And the reason it's higher, if you look in the middle of that page over to the right, it shows the annual gross income is a total of $845, which is $10,000 a year. So that bumps up your return to the 17% because you've got like two houses built into one, and that's what a double or a duplex is. I'm sure a lot of you know what that is. But here's the bottom line. People think, wow, that's 17%. That's got to be a lot better than the 13%. Well, no, not necessarily, and I'll tell you why. Because duplexes are good, and if you're looking strictly just for income and not maybe planning on selling it much in the future, that is good. That is very good. But the point is, a single-family house is more in demand. There's more people out there who would want to live in a single-family house and who would want to buy a single-family house because they could live in it as their home than people would want to buy a duplex. So what you have is a higher demand and it's more liquid. A single-family house is easier to liquidate and sell than a duplex. More investors would buy duplexes than homeowners. So the fact that you've got increased liquidity in an asset sometimes makes it more valuable. So many times I'd rather take the single-family home because then I can, down the road, sell it to a homeowner or an investor. Whereas with the duplex, it's a little more restricted to investors, which limits your market a little bit. And higher return, yes, but there's pluses and minuses to everything. All right, I'm ready for the next slide, Jason.
All righty. Now, guys, real quick, I just wanted to make sure that you had Jeff's contact information. So if you want to get some cash flow coming in and you want to talk to Jeff, you could get into contact with him by visiting his user-friendly website, which is at investindy.com, or you can email him at jeff@investindy.com, or you could give him a personal call at 317-507-4323. If you have any interest in moving forward investing in the Indianapolis market for some buy and hold properties with renters already in them, then get into contact today with Jeff as his inventory does not last long. Now, guys, I'm going to leave this page up here for just a second so you can write down Jeff's information. Now, I am recording this. It'll go in our membership area, and I'll also put it up on our blog so people can also see this information for a little bit. But most of this is going to be for our members only. But I want to let you know we're going to be unmuting the lines and taking some questions here from some individuals that have questions for Jeff. And the one thing that we really did not cover that I just want to let you guys know, all of the properties that Jeff has as a buy and hold investment opportunity already have the renters in the properties. So there isn't any lag time for when you put down, say for instance you come in with all cash, or say for instance you come in with the 30% down. There's no lag time for him to get you a renter. All of the properties that he has in inventory already have renters in them. Okay, and you're not dealing with a property management company that just opened, 6 months to 2 years ago, and the person just got their real estate license and they're now a property manager. Jeff has been in this business. Him and his wife have been in this business for over 30 plus years. They manage over 1,000 residential properties right now, currently within their management database. This is huge. You want to go with somebody that obviously knows their market, knows what's going on, and can make sure that it's a great investment opportunity for yourself. So with that being said, let me go to the next slide here and give you the instructions on actually getting unmuted. So all you need to do if you want to get unmuted and talk to Jeff and myself, just simply raise your hand by using the control panel provided to you by the GoToWebinar software. And then you can either use your microphone provided with your computer, or you can use your telephone. Landline or cell phone will be fine. I'll go ahead and unmute you, and we could speak one-on-one with each other. Now, if you can't speak live on the call, type in your questions within the box provided to you by GoToWebinar. I'll make sure to answer as many questions as possible. Now, if for some reason I don't get to your question, send us an email at assetmanagermillions@gmail.com. All right, so let me go ahead here, get out, and go ahead and start answering some questions here. Let me see if we've got anybody that would like to talk to us. We've got Renee and Ron that would like to talk to us, so I'm going to go ahead and unmute you right now. So Renee, I'm going to unmute you first. Okay. Hello, Renee. How are you? Renee, are you with us? Okay, I'm gonna have to unmute you or mute you back. We've got Ron Marshall. Ron, I'm gonna go ahead and unmute you. Hey, Ron, how's it going? Ron? Okay. Ron, sorry, buddy, I couldn't hear you. Okay, we've got John, and I'm going to unmute him. Hello, John. Jason Lucchesi here. How's it going?
I'm good, Jason. How are you?
Good, good. Thanks for joining us this evening. What kind of questions do you have for Jeff?
It's pretty basic, but my question is, after the 10-year period or after the home is actually paid off, will Jeff's management company continue to manage the property for us? And at that point, how do the terms change, or is there any change?
No, John, there's no change. We continue to manage it just the same as we would before.
Okay.
You have the right to go to another management company too. If you don't like us, we don't make you stay with us. We don't make you do anything. So we want you to be happy, and my goal is to have people that I do business with that are happy with us, that are thrilled with their investment, that are getting a good return. That's my goal. I want you to be happy. I want you getting a good return, because that's just what I want. And if you're unhappy with this, there's other management companies, and I doubt that would happen. But we don't try to put a noose around your neck and say, this is what you can do or can't do. This is how it works. We want you to be happy, and we would continue to manage your property, and we would manage it in the same fashion, because that's a huge part of our business, property management. We make money off it, so we've got to do a good job.
Great. Just for the record, I like you already, Jeff. So.
Thank you.
Well, hey, John, thanks for joining us. Great question. If you have any more, just let us know. We'll be more than happy to answer that for you.
Cool. Thanks, Jason.
No problem. Have a good night, buddy.
You too.
Thanks. All right, we've got another question from John E. Okay, so I'm going to go ahead and unmute you. Hey, John, how's it going?
Good evening, Jason and Jeff.
How are you doing, buddy?
Real good, thank you.
Good. I saw that you typed in a question. I'm assuming that's the question that you wanted to go ahead and ask Jeff.
Yeah, it's along those lines. Should I restate it?
No, go ahead, buddy. Yeah,
Okay.
If you could, because Jeff doesn't see the questions that come in. Only the organizer sees them. So if you don't mind just repeating that for Jeff, I would greatly appreciate it.
That's fine. Jeff, I wanted to ask, if you did buy a property through your IRA, is this allowed according to, well, I'm with Equity Trust Company, self-directed IRA, and I've been led to believe that you cannot have a loan or mortgage on a property that's in your IRA. I don't know if this is their rule, the IRS's rule, or what, so maybe you could straighten me out on that.
Well, here's how I would straighten it out. I've sold 2 in the last 30 days through Equity Trust
Okay.
with my finance program, and it's been approved.
Okay.
So there was no problem whatsoever. At first, they're not used to it a little bit, because not everybody does that, okay?
Uh-huh.
But once they see the mortgage papers, and they're written up by a qualified real estate attorney, okay, who's very, very sophisticated and Same with the note and mortgage, and they look to pay. They say, hey, this is legitimate. And the bottom line is, yes, it is authorized by the IRS. It is okay to leverage your investments in a self-directed IRA, and equity trust is just fine with it as long as the paperwork is correct.
So it's not that it's just through an individual or individual company versus a bank. It's just it's allowed, but they weren't used to it, so they sort of shied away from it.
Well, I don't know that they weren't used to it. Here's probably why they might seem to have shied away from it, because there's two types of loans. There's the regular real estate loan, which happens much of the time, okay, and then there's a non-recourse loan, and most of the banks do not do non-recourse loans, and the IRS says that the loan in your IRA or 401k has to be what they call a non-recourse loan. And what a non-recourse loan is this: if you buy this house from me, if your IRA buys it, it's not you who's buying it, it's your IRA who's buying it, and you finance it, the IRS says it has to be a non-recourse. And what that means is that if you stop paying me and I would have to foreclose on that house, all I can get back is the house itself. I have no recourse to any other assets that you own or other assets in your IRA, just the house. And because that's the terms of my loan, which is to your benefit, okay, then it qualifies as far as the IRS. If it was not a non-recourse loan, then that means I could go after all kinds of assets. In other words, it's like you're personally responsible. And the minute you hook the word personally responsible to something to do with an IRA, it's disqualified. So by nature, the definition of this loan is a non-recourse loan, and it's perfectly all right, and that's how it has to be with the IRS. Only the house can be taken back if a person stops paying it and there's a foreclosure, not stuff that you own outside of the IRA or other stuff inside of your IRA.
Okay, that's great,
Jeff.
Jeff.
A little more clear for you?
Definitely. Jason, could I sneak in another question?
Oh, go ahead, buddy. Go ahead.
Okay. I appreciate that. I wanted to ask Jeff also about if you did buy a property through you and then you wanted to sell the property to the tenant, is the tenant our tenant or your tenant? I mean, can we communicate with them?
He's your tenant. He is your tenant, and it's your house. Everything about this asset is YOURS, yours, because that's the beauty of it. You own it. I don't. We just manage it for you.
All right. And would there be a early payoff penalty if you didn't go the 10-year balloon, the 10-year length of the loan before the balloon?
Absolutely not.
Okay.
The sooner you paid it off, the happier I am.
Okay. All right.
We've got like a partnership going here, you and me. If you buy a house from me, and I loan you the money for it, because see, it's in my best interest to be your partner, to manage this thing as best as I can to make sure that I get the maximum cash flow for you. Because guess what? You're paying me back. You're making those loan payments with that cash flow that comes out of that property. So I want to manage it good. I want to make sure you can make your mortgage payment. I want to make sure that you've got enough money to keep paying me month after month after month. And if you decide to pay off this thing, even faster, because that means you're going to pay thousands and thousands less in interest to me, and you're going to end up saving thousands and thousands of dollars in interest. And in the end, your property, when it's paid off, that's when it really kicks in and turns into a cash flow machine.
Okay. And does Indiana allow lease options?
Yes, they do.
All right. Okay, I've hogged the floor enough. Thank you very much, Jason and Jeff.
Thank you, John. You have a great evening, buddy.
Thank you.
Thanks. All right, great. That John E. was the last one with his hand raised. So if anybody else would like to raise their hand and ask Jeff questions, go ahead. But I'm going to start answering, or have Jeff start answering some of the questions that came in here. Scott S. is asking you, Jeff, what if someone didn't have the cash? Can you do this in conjunction with private money? Thus, who would have first position?
Well, I'm not sure. Basically, you know what? I'm not sure the answer to that question because I never really thought about it. I would have to say that the person who's buying, I would have first position.
That's what I was gonna say
Yeah.
because you're taking on 70% of the risk. So
Yes.
if
I'd have.
somebody Scott, if somebody came in with 30%, which is a really great idea, if you're trying to do some cash flow opportunities, you can get the 30% from a private money individual, but they would just have to know that they would be in second lien position because Jeff is taking on 70%. And the investor, private money investor, would be taking on 30. So I hope that answers your question. Greg M. Hey, Greg. Hope everything's going well with you. Greg is asking, explain the non-recourse loan, please. I know you just mentioned that here with John, but can you just reiterate it?
Yes, sure. I'm not an attorney, so I'm kind of doing this off the cuff here. But what it is this: let's say we've got this loan. Your IRA bought a house. Okay, let's say you've got $100,000 of cash in your IRA. Okay, but you bought this house for $30,000. So originally you had $130,000 in your IRA, but now you've got the $30,000 out of it to pay for the down payment on the house. And you've still got $100,000 of cash sitting there, just sitting there doing nothing, okay? But you got the house and the $100,000. If you stopped paying your payments, which wouldn't make sense if you've got $100,000 sitting in your IRA, but I'm using an example here of what non-recourse is. The only thing, if there was a lot of damage to the house, a tenant really messed it up or whatever, or a tornado came and blew it away and you stopped your insurance or whatever, I'm only entitled by the courts through a non-recourse loan to have recourse to that house itself. I can't go after any of that $100,000 sitting there, okay? I cannot do that. Other types of loans, which are not NOT, non-recourse, the financial institution or the bank can not only go after the asset, but let's say it was severely damaged and there was all kinds of things. They can go after your other personal assets. They could go after your car. If you had another house, they could go after that to get those damages taken care of. With non-recourse, only the house itself. And that's what makes the IRS say it's okay, because once you can go outside of the IRA to get funds, if it was a non-recourse loan, that means it's tying it to a personal use thing, and that disqualifies. Anytime you go outside of the IRA for money, the IRS says that's a no-no, and we're going to disqualify it. But when you have the words non-recourse loan in there, it just automatically qualifies it, your asset for financing. I hope I explained that better. It means you can only go after the asset itself, not any other collateral assets that person owns.
No,
Does that make it a little clearer?
That was explained extremely clear. Great response. And I've got a question, well, actually a couple questions from Jane P. She's asking, it says 0 closing costs. How can that be accurate?
Well, it's accurate because I'm loaning the money, so I've decided not to charge anybody any closing costs. I'm paying them all.
Good. Okay.
And that cost me some money, believe me. But I just figured, things are complicated out there enough as it is, guys and gals. I mean, ladies and gentlemen, things are complicated. When you see these HUD statements and these banks and all these charges and recording charges and title this, title that, I tell you, it blows me away. And then I look at these expenses. So what I've done is I've done the best I can to keep it clean, simple, and neat, and to help you guys, whoever participates in this type of thing, to make it easy, simple, so you can understand the numbers and keep your costs down so you can have a good investment.
Good. Okay, good. Trisha is asking, so who pays for the utilities?
The tenant pays the utilities. The tenant does.
Okay.
Okay, now, I have to say something. If the house goes vacant, the tenant isn't there to pay the utilities. Then you're responsible.
Okay. That makes sense. Jane had another question come in. Why is rent $625 a month and the month vacancy is $600?
Because we've estimated, and like I want to make this clear, these are estimates. These are not guaranteed numbers. there are averages that are used in this industry by someone like me who's had some experience of 5-year, 7-year averages. I've taken 8% of the rental revenue. So whatever that rental revenue is showing in that illustration, if it was 625, that's what I believe you said, that number is $7,500 of rental revenue. If we take 8%, that's $600 of attributed towards vacancy in a year. We use 7% approximately for the maintenance incurred. So if you've got a $7,500 annual rental income, gross revenues, at 7%, that maintenance figure a year is $525. Now, sometimes that figure could be $200 a year in maintenance. Other times it could be $800 or $900 if a tenant moves out. These are just averages and estimates. So sometime that vacancy, it could be, a month and a half, or it could only be 2 weeks before we get that property leased when the tenant moves out. So that's just an average, and we took 8% of the $7,500, which is approximately 1 month's rent.
Okay, gotcha.
Does that make sense? Ask the lady if it makes sense, Jason. I hope I was clear on that.
Sure. Jane, if that didn't make sense, please respond back and let us know if that didn't make sense. Let's see here. Terry M is asking, do you buy REO properties and or short sale properties if they are in the Indianapolis area?
I have not bought many short sale properties. I could. I do buy REOs. I buy whatever is a good buy, and that's what counts. Is not where it comes from. It could be a HUD. It could be a homeowner. It could be I'm talking to a tenant at one house, and I see the neighbor across, and I ask them if they're interested in selling their house, and maybe they say yes, and that has happened. And I buy that house because it's a great deal. And if it's not a great deal, I don't buy it. So I look for a deal, a really, really, really good deal. And then we take it from there. Many of these properties, I've owned some of them for 1 year, 2 years, 5 years. Some of these houses I've owned for as long as 10 years. So these are in my portfolio as well. And as I sell them and free up the capital, I'm buying new houses, not brand new houses, but new investments to sell more to investors. And that's how I keep turning my money.
Okay, gotcha. Now, Renee is asking, how many notes can you create without being in trouble with the mortgage law?
Okay, what was that again?
How many notes, mortgage notes, can you create without being in trouble with the mortgage law? And I'm assuming
okay, there is no mortgage law
right.
when it's an individual, okay?
Right, that's...
And if I'm the mortgage, I guess, mortgagee...
Yeah, you'd be the mortgagee.
I'm the mortgagee, one giving the mortgage and making the loan, and since it's my money and I'm not a bank that's federally regulated, I'm not a bank, I can make as many as I want. And you're not violating, and I'm not violating any laws, especially since you're an investor. Now, there's something called the SAFE Act out, which I won't get into, but if I was selling you this house and financing for you to live in as your primary place of residence, then I would have to do some other things that comply with the law called the SAFE Act. But when you're buying it as an investment, there's no limitations. The only limitation would be how many homes could I finance. I may run into a situation where I can't finance them anymore, and people would just have to be paying all cash for them. The financing thing is good, but there may be a time when that comes into an end, or I decide it's not as profitable for me. So what I want to tell you folks is do it while I'm offering it, because I may not offer it forever. In fact, I'm not going to offer it forever. And then you'll just be paying full cash. It'll still be a great deal, but this is kind of a really, really unique thing right now.
Well, Jeff, that leads into the next question. Great. Is Carl S. is asking, do you get a discount for paying cash? If so, how much?
Well, I can't say specifically because it depends on the house. Generally, I don't give a discount for paying cash. But Ray, if you want to talk to me about one of the houses, I'd be glad to talk to you about it, and maybe we can work something out.
Perfect. Donna is asking, what suggestion would you give in looking for a management company? And I'm assuming she's obviously thinking outside of Indiana on this.
Absolutely, absolutely. Be
'Cause
glad to
I know
help with that.
Donna's on the East Coast,
Wonderful.
so
And what I would do, I would look for someone obviously who's established, who's been in business a long time, who just didn't start up 4 years ago, and say, I'm a management company. And another thing I ran into recently is I found companies who were selling properties, and then they sold them like I'm doing and managed them. Okay, I'm doing that. But see, I was a property management company long before I ever had this Invest Indy company or was selling properties to investors. I only bought them for myself and managed for other investors who already bought them for themselves. I had the philosophy years ago that, I could buy a house for myself and fix it up and do real good with it. But if I made a mistake, the mistake was on me because it was my house. I didn't want to take 10 years ago responsibility for making a mistake, on someone else's dime. But I looked at all the other investors out there and how they were making mistakes 10 times more than I ever did. And other people, realtors, different people were advising people to make investments, and they were really not good. It was really not good advice. I said, man, I could really help people by telling them where to buy, what to buy, how to buy it, and take care of it for them and manage it for them because I had a lot of experience to keep them out of keep them from making mistakes, keeping them from buying in the wrong areas, and helping them along with investments and telling them when to and when not to buy. So back to the real estate property management company question is that they have a lot of experience. Check with other people in the area. Get references from them, some of the people they manage properties for, and say, can I call some of these people? If they say, no, you can't call any of these people, I'd be suspicious. I'd be immediately suspicious. If they don't want you to call anybody, to me, they're hiding something. I've got clients you can call and say, are these guys any good? I got lots of them. And they'll tell you. Plus, the fact that they've got experience in the market means they probably know the area pretty well. So if someone's bringing a property to you, you could call them up and say, what do you think of this area? And they're going to be objective, generally, unless they've got something in cahoots with the real estate agent. Be careful of that. But the point is that doesn't happen very often. Usually real estate agents are honest, but they don't always know. They want to make a sale. But the property management company doesn't want to manage something that they can't get rented fast, so they need to tell you, this area is good, but this area isn't so good. Things like that are what make a good property management company. I would say they should charge no more than 10% of gross rents, and many companies charge anywhere from $300 to half the first month's rent or a full month's rent for a leasing fee. And all those are pretty fair. We charge half the first month's rent to lease a property up. That's what we charge. Many charge full month's rent to do that. So 10% is a good guideline, half the first month's rent to get it leased. Making sure you're getting statements every month, making sure you get your cash on time every month, and these kinds of things, and able to call for references and that they have experience.
Okay, great. Christina's asking, with the 10-year balloon, if you are paying extra toward the balance each year, does the payment readjust each year, or does it stay the same for the entire 10 years? And then at the end of the 10-year period, the loan balance would just be lower?
Yes, that's a good question. The payment stays the same. It's just as if you had a home mortgage on a 30-year home mortgage. If that payment was, $500 a month for your home mortgage, it never changes unless it's a different type of loan. What I'm talking about is a fixed rate mortgage. It's fixed. That payment is fixed. The interest and principal together equals the same amount every month. So no, your payment does not change with me. At the end of 10 years, if you've paid down half of the mortgage, let's say, only half, then at the 10th year, you've got to find a way to come up with the other half to pay it off and be done with it. If you haven't paid off any of it because you've taken all the money and you went to the gambling boat and spent it, well, then you're going to have quite a bit due by the 10th year, okay, that you have to pay off. So the object is to pay your mortgage payments, pay all your expenses, and take money that you're making from that property and reduce that balance. And in 10 years, you could potentially pay every dime of that mortgage balance off at the end of 10 years. And after 10 years, you'd have no payment whatsoever. That's what we'd like to see.
Perfect. Question for you, Dan, from Dan D. He is asking, why wouldn't Jeff just keep these properties and continue to rent and pay off the properties instead of financing 70% for others? And real quick, Jeff, real quick, I just want to say this to Dan, and correct me if I'm wrong, but all of these properties, Dan, are free and clear. Jeff owns them all free and clear. So he's got free and clear title on all of them. So correct me if I'm wrong on that, Jeff, but is there anything else you'd like to mention to Dan?
Well, I do own them free and clear. There's a couple that have small mortgages on them, but I own the vast majority free and clear. And the idea is, why wouldn't I keep them for myself? Well, I have quite a bit. I have apartments, I have these, and what happens is, because they're free and clear, when I sell one, I get a chunk of cash. And what do I do with that chunk of cash? I can turn around and buy 2 more houses. So I can take my money that I make from the sale of these houses for other investors, and I can redeploy it into additional pieces of real estate, which makes me more money and then allows me to turn around and do the same thing to sell a great deal, again, to an investor, and have more in my own portfolio.
Right, definitely. Carl is asking, do these properties have current COs?
Current what?
COs?
I'm not sure what that is.
I'm not either. Carl, if you could let us know what you mean by COs, that would be great. I'm kind of unsure. Carl is typing in certificate of occupancy. Or no, Keith actually said certificate of occupancy.
I don't think we have to have that here.
No,
in Indiana.
I haven't heard of that in Indiana.
No, that's in other states. We are licensed. We are licensed property managers. I will say that, licensed by the state of Indiana. And we have a broker who is my wife, who really, she doesn't sell anything, but by law, you have to have a real estate broker's license to run a property management company in Indiana. And we are licensed, but there's no certificate of occupancy.
Gotcha. Okay. Do you still get a management fee if the property isn't rented for a month or two?
No, we don't.
Okay, great. Okay. Timothy is asking, what other cities in Indiana would you be interested in? Anderson, Kokomo?
Basically, we try to stick with what we know, and I'm sure there's good houses in those areas as well. But we try to stick to Indianapolis and the surrounding counties, which is over a million people. So for us, that's really enough, and we don't get involved in areas that are, over an hour away. It turns into a cumbersome thing to manage it properly.
Sure, definitely.
For us too. It doesn't mean you shouldn't buy one. It doesn't mean that at all. It just means we couldn't do it for you.
Okay. Keith is asking, is it better to get a loan from your 401k or change it to a self-directed IRA?
Is it better to get a loan from your 401k?
Yeah, take a loan out and just repay it back yourself.
Well, I think that you could do that because I understand if it's a solo 401k, is that what they're talking about? Probably a self-directed 401k. You can borrow. From my understanding, you can borrow half the value, up to $50,000 of a solo self-directed IRA. So that would be a good thing because the interest rate would be low, and the difference is that the income is taxable, except for depreciation when it's outside of your 401k. When it's in your 401k, that cash flow is not taxable. So you know what? They're both good. They're both good. I don't have a definitive answer of one being better than the other. They're just two different things.
Okay, gotcha. John E., who was just on not too long ago, that asked us a couple of questions.
Sure.
He's asking, Jason, does Jeff provide monthly payment reports, like servicing reports, to the owner, or just make the payments to the Sidra company? Thank you, John E.
We make, I'm going to clarify this with my wife. In fact, I was going to talk to her about this tonight, but we do have monthly reports, and I know that we send them to the owners. And if not, we will send it to the owners. I know we have to send it to the, I believe we have to send it to Equity Trust, but I'm 99% sure we send it to the owners because they're the ones who want to see it.
Okay, great. We had Ron M. Raise his hand, so I'm going to go ahead and unmute him. Hey, Ron, are you there? Okay, Ron is not answering, so we'll go ahead and answer a couple more questions here. Now, Shaw, it looks like you've asked quite a few questions. If you can you go ahead and raise your hand so I could unmute you? It looks like you've asked quite a few questions and I'd like to get them answered. So if you could, I would greatly appreciate that. But I'm going to go ahead and answer a couple more here. James W. is asking, is there a website where I could find out more about your program? And guys, Jeff doesn't have like a program or anything like that. This is, strictly for, if you're looking for investment opportunities. He has a website you could go to if you want to visit like any of his, if you want to take a look at any of his properties. You could also email him, and I'm going to put that in the box right now. If you guys want to email him or check out his website, it's investindy, and that's INDY.com, and his email is jeff@investindy.com. So feel free to reach out to him at any time. He would be more than happy to speak with you. All right.
Right. And I wanted to clarify, I just spoke to my wife while you were talking, Jason, and in answer to the person's questions about the monthly statements, we send monthly statements out regardless every single month with a full accounting of all the expenses and all the revenues on the property and what the profit is. And so an owner gets that every month. And yes, he was asking, would the owner get that or the IRA company? The owner gets that statement. The owner of the IRA would get that statement every month.
Okay. Gotcha. All right. Lau is asking, is this being recorded? Yes, it is being recorded. I will have it up tomorrow. So okay.
I wanted to tell the group something else too, Jason, because they're able to do research and have all kinds of questions, and one was on this non-recourse. There are a handful of banks that loan money to people who want to buy a property in their IRA. There's probably 4 or 5 in the country that do that. The problem is, my properties are at such a great price, they will not loan money on a property that inexpensive. In other words, they require that house be a $70,000 or $80,000 house before they'll even consider a loan. My houses are $40,000, $50,000, and $60,000. So they won't even think about lending it because they can't make enough money on it. That's why my program is kind of unique, because there's virtually no financial institutions who are interested in loaning on these types of properties at this price range.
Gotcha. Shaw asked a great question. If the Indy props are bought by a California LLC, does the LLC have to be registered in Indiana? And I know, Jeff, you're not an accountant or a lawyer, but do you have any answers on that?
I don't have an answer. I would say probably not. I would say probably not, because I remember I just sold some properties to a person who had an LLC, okay, and it was a Wyoming LLC registered in the contract. It said this LLC was registered in the state of Wyoming. It was not registered in Indiana. It does not have to be registered in Indiana. In answer to your question, I just answered both of our questions. No, it does not.
Good. And yeah, I just, I wanted to kind of mention on that, again, neither Jeff or myself are attorneys or accountants or CPAs, but we do business all the time with people that have LLCs registered all over the country that buy in Indiana. And I haven't seen any problems with it, but again, I don't know if they have some special way that they do it, but most of the people that are doing it are based in other states.
Something too, Jason.
Yes.
I wanted to clarify for the people too. I know the amount of money on some of these down payments is low, and doesn't require huge amounts of money to get these properties. And frankly, it's just as good to buy them outside of your IRA as it is inside of your IRA. And sometimes it's even better because you get depreciation outside of your IRA. So it doesn't matter whether it's money where you sell stocks to buy it that you feel are not doing so good, or you cash in a CD, or it's money in your savings account, or if it's in a retirement plan. But the bottom line is, even though it's a small amount of money, or whether you decide to pay cash, all cash for these properties, which is really, really, really the best way to do it, because it's going to give you maximum cash flow, and it just reduces the problem of having another payment. It's really even better if you can do that, to pay all cash for it. But here's what I want to say. You should always have a reserve. Whether you're buying the property for 30% down, you should always have $3,000, $4,000, $5,000 sitting to the side, untouched, as a reserve. In other words, you don't take all your money you can for a down payment and not have any other funds available because you spend all your money on this down payment and have nothing left. That's not the way to buy real estate. If I find out that's the case, I won't sell it to you, because I want you to be safe and comfortable and do it in a responsible manner and intelligent manner.
Gotcha. Jeff, we're getting a question. Are there any restrictions in the number of houses that can be bought by from Invest Indy by one buyer?
No, there's no restriction, as long as they've got the money to pay for it. And I'm able to sell the house to them. And I have enough houses to sell them to them. There's no restriction.
Well, that leads into the next question. Somebody's asking, how many houses are available for investors right now?
Right now, I would say I've probably got 15 or 20 sitting, and I haven't even prepared illustrations on all of them. I've got about...
They're pretty new, right?
Yeah, they're ones that are just coming out, okay, to be sold. So I haven't prepared. I'm working on illustrations. I've got probably 15 or 20 available. I just sold 7 in the last 30 days. I've got another 15 or 20 ready to come on board, and that means to be put on my website. I'm not going to put them all on there because it's confusing people. But I've got 3 that I just showed tonight. I'll have another 3 up within the next week. So there's 6 right there to look at. And if somebody wants more than that, they can talk to me about it.
Now, Jeff, somebody was asking, how many of these deals have you done with investors? And it was
how many?
Yeah, it was question mark 100. How many have you done with investors?
How many have I sold to investors? Is that what you're saying?
Yes.
I probably sold 20, and I haven't managed all of them because some of this is throughout the years. Probably 20 houses like this. Okay.
20 houses a year.
Yes.
And how many years have you done that?
And the bottom line is, we manage tons and tons of houses for investors, ones that I didn't even sell to them. Okay. And so right now, I've sold, I would say, to be honest with you, it's not a huge quantity that I've sold to investors. Probably, maybe 30 over the last, 3 or 4 years.
Okay. And you guys...
I did not have Invest Indy at that time, and I've basically just been buying for myself.
Okay. Gotcha. Carl is asking, are all of these properties fixed up when you sell them?
Absolutely. They're
Okay.
fixed up and with a tenant in them. We have to fix them up and fix them up nicely because they wouldn't rent.
Okay. Now, Shaw, I'm sorry, but we're not going to be able to go through this. I am recording this, and it'll go up tomorrow, and you could check it out if you want. But Shaw is asking for a background on yourself, but Jeff, we're kind of running out of time here, so Shaw,
Shaw can call me. Shaw could call me personally if she wants it. I'd be glad to tell her anything
okay.
she wants.
I don't know. Yeah. Okay. And I think Renee's going to be getting in contact with you.
Okay.
She was asking some questions that I can't. It's kind of off topic for this, but Jeff, Renee, I would recommend that you call Jeff or you shoot him an email, and I'm sending you that information right now.
Right, and they can look on my website again, Jason. It's got my phone number on the website, my cell phone, and it's got my email address at the www.inbest as in invest and then indy.com. If they write that down, they can look on my website, get my phone number. They can email me, and I'd be glad to answer any questions, even if it's regard to a rental property that they own and they're not interested in doing something in Indianapolis. I'd be glad to help them, Jason, and answer any question I can.
I know you're always extremely helpful. That's why I think you and I are becoming such great friends. John said, thanks to the both of you for this unique and valuable webinar. And Jason, the AMM program is awesome and your bonuses are much appreciated. I am new to the program, but drinking it all all in with enthusiasm. John, thank you for the great words. And guys, it looks like we're out of questions. I know there's still some coming in, but guys, it's about 9:30 here for us, and I've got some things in the morning that I have to get ready for. But Jeff, is there any parting words that you would like to leave with?
Well, I will say this. When I was younger, I looked at real estate, and this was before there were any gurus, before there were TV shows, and I was very excited about it, probably like all you people. And I know Jason is instrumental here in helping you people become successful real estate investors through his programs and his initiatives. And I just want to say, stay excited about it. You don't have to do what I do, but I will say this. Over the years, by buying a house here and buying one there and holding it and buying another one and then finding another deal year after year after year, pretty soon, folks, it really mounts up. It creates a tremendous, wonderful set of properties and assets and really creates a great net worth if you do it. You don't have to do it fast. Just do a little at a time. Get rich slow is what they call it. And in the meantime, you can be flipping properties and making cash to buy those properties with. That's the best model. Is, if you can find a property and flip it, or if you wholesale it, or whatever other ways you make money. If you're a doctor, a lawyer, I don't care, dentist, if you're making money, put some of that into buy and hold real estate. And down the road, you'll be very happy you did. That's all I have to say.
And guys, like Jeff was saying, I put this webinar out there because I've been getting asked a lot of questions about cash flow and certain things along those lines, especially with creating notes. Jeff creates his own notes. A lot of people across the country create their own notes. Jeff does it in a really unique way. I really want to get him on. He's from my area. And he's a good friend of mine, somebody I really, truly trust and value as a very good friend of mine. And I want to get him on here because what he's doing, I don't really see a whole lot of other people doing it. And that's why I wanted to bring him on here as a very special guest. So if you can, Jeff, I really want to say thank you for taking time out of your Sunday evening to do this with us. We actually had a really great audience come on board for this advanced webinar clinic, and we did go over a lot of question and answers. So I want to make sure everybody got as much out of this as possible. We're always here to share, to help, inform you, and really truly get you on the successful path. And like my screen says right here, I'm gonna show you it really quick. My last slide here is think it, plan it, execute it. And it can't really be put into too many different words than that. It really has to come to your thoughts, write it down, execute it. And with what we had tonight with Jeff on here, is really something that you really don't have to think too much about, because Jeff has really put this on a silver platter if you really do want to invest some of your money with him. So I don't want to take up too much more time, but guys, thank you very much for attending. And yes, this is recorded. It will be popped up tomorrow, which is going to be July 2nd. So with that being said, guys, thanks for your time. If you need anything, send me an email. Be more than happy to answer any of your questions. Thank you, Jeff. Have a great night, everybody.
Thank you, Jason.
The organizer has ended the session, and this call will be disconnected.